Assalamualaikum everyone. Welcome back. Today our video is about dividend policy. A dividend policy basically outlines how a company will distribute its dividends to its shareholders. This policy details specifics about payouts including how often, when and how much is distributed. There are many types of dividend policies including stable, constant and residual policies. Before we jump into looking at dividend policies, let's talk about dividends. Dividends are a distribution of a portion of a company's earning to its shareholders. A company can choose to reinvest those earnings into itself to drive future growth, or it can distribute those earnings to whoever owns equity in the companies. So the decision to pay dividend is influenced by the company's profitability, cash flow, financial health, and growth of the company. So basically, it describes the fact that mature companies in stable industries may not need as much cash, so they may be more likely to issue dividends. However, growth oriented companies in capital intensive sectors like technology or biotechnology may prefer to hold on to their cash and not issue dividends. In either case, the company needs to have the policy that outlines what it plans to do. And we'll talk about that policy next. Having a dividend policy in place is important for dividend paying companies. And this dividend policy structure highlights several key points, including how often dividends are paid out, when they are paid, and how much to pay shareholders. An additional factor to consider includes providing shareholders with the options to take their dividends in cash or allowing them to reinvest them by purchasing additional shares through a dividend reinvestment program. In our coming slides, we are going to discuss the types of dividend policies one by one. Companies uses at least one of the dividend policies outlined below, that is stable dividend policy, constant dividend policy, residual dividend policies, no dividend policy and hybrid dividend policy. So our first dividend policy is stable dividend policy, which is the easiest and most commonly used. The goal of this policy is to provide shareholders with the steady and predictable dividend payout each year, which is what most investors seeks. Investor receives a dividend regardless of whether the earnings are up or down. The goal is to align the dividend policies with the long-term growth of the company rather than with quarterly earnings volatility. This approach gives the shareholders more certainty concerning the amount and timing of the dividend. However, the primary drawback of the stable dividend policy is that investors may not see a dividend increase in boom years. So, our second policy is constant dividend policy. So, under this policy, a company pays a percentage of its earnings as dividend every year. In this way, investors experience the full volatility of company earnings. If earnings are up, investors get a larger dividend. And if earnings are down, investor may not receive a dividend. So the primary drawback to the method is the volatility of earnings and dividends. It is difficult to plan financially when dividend income is highly volatile. So, our third dividend policy is residual dividend policy. It is also highly volatile, but some investors see it as the only acceptable dividend policy. So, with the residual dividend policy, the company pays out what the dividend remain after the company has paid for capital expenditures and working capital. So, if the company's management team doesn't believe they can adhere to the strict dividend policy with consistent payouts, it might opt for the residual method, as it allows the companies to use their retained earning or residual income to invest back into the company or into other profitable projects before returning funds back to the shareholders in the form of dividends. The drawback to the residual method is that it can lead to inconsistent and sporadic dividend payouts, resulting in volatility in company's stock price. Some companies decide not to pay dividends at all, particularly those in high growth industries or early stage startups, reinvesting profits to fuel expansion. These companies prioritize reinvestments of earnings into research, development, acquisitions, or debt reduction rather than distributing dividends. By foregoing dividends, the company aims to accelerate growth and enhance shareholder value through a higher future stock price rather than income generation. Note that this type of policies may actually still be documented. A hybrid dividend policies combines elements of different policies stated before. For example, a manufacturing companies might adopt a hybrid policy by offering a stable base dividend supplemented by additional payout based on residual earnings from exceptional period or one-time gains. This approach allows flexibility so that investors can expect a baseline amount of dividend but also realize that they may be awarded higher dividends if operations go well. Thank you so much for sticking around till the end. So hit like, share, and subscribe because why not? So catch you in the next video. Allah Hafiz.